Alright guys, a very warm welcome to another week ahead video. For the week starting the 25th of January 2021, our main focus will turn to the incoming FOMC meeting that will take place on Wednesday and how we're looking at this event to create some possible trading opportunities in the week ahead. Now, it's only been 3 short trading weeks into the new year, and it seems like there's already once again that big growing divide amongst those market participants who think that the end is near and those that think that this reflationary trade is actually just getting started. Now, when we look at something like the major global macro markets, something like the S&P mini, looking at the 10-year inflation expectations, WTI, US 10-year, as well as the dollar index, it's very clear that assets are still very much priced for a bigger, a brighter, as well as a better future going into 2021. Now, the market's expectations for a more robust global as well as a synchronized economic recovery, alongside, of course, that reflationary environment, has also rubbed off on some central bankers recently, such as Fitch Bostich, who explained that they are actually hopeful that in a fairly short order, they might be able to start recalibrate. Now, this viewpoint was also shared by some other colleagues and created further push higher in something like US 10-year until Fed Chair Powell and some of the other members actually had to step in and put out the fire. Now, the optimism from Bostich has some credence because the mass scale vaccine distributions alongside a blue sweep victory for the Democrats, as well as that ultra easy monetary policy, runs the risk of seeing potential upside surprises for both growth and inflation in 2021. You know, some investment banks like ING recently upgraded their US GDP forecast to 5% for 2021. And given the low base effects alone, going into that first part of the year, the odds of upside surprises are a lot higher. Now, what's also interesting, in a recent economist survey that Bloomberg did, they reported that over 88% of economists polled saw the Fed slowing their asset purchases rather than increasing them in the next 2 years. And the recent rise in taper expectations should cause some worries for the Fed and might see some additional or more explicit pushback from Fed Chair Powell in this upcoming FOMC meeting this week. Now, for many market participants, the FOMC rate decision, the statement, and the press conference this week is largely expected to be more of a non-event, and with no changes expected in terms of interest rates or really any other changes in terms of the current policy. Now, the bigger focus from our side would be to focus on whether the bank pushes back more explicitly and directly regarding the recent flare-up that we've seen in taper talks. And why should they be concerned about this? Well, if we take a look at this chart, this is basically US 10-year bond yields going back to April 2013 all the way up to September. Now, back in 2013, the very suggestion that was made by the then Fed Chair Ben Bernanke actually saw the US 10-year, like we can see from this chart, almost doubling and by jolting from 1.6% all the way up to 3% in just 4 short months. And the fear of having a rerun of that taper tantrum, as it's called, really sparked both Fed Chair Powell as well as Vice Chair Clarida to speak up and explain that taper is still a very far way away. Now, in the video appearance that Powell did, he explained that now is not the time to be talking about an exit from asset purchases, and also stressed, that they will let the world know well in advance when it's time for them to start doing so. And the very last thing that the Fed would want right now is tighter monetary policy conditions. Now, they fought way too hard and threw in, way too much behind their current easing package to just let it all fall apart at the first sign of expected economic progress in the new year. Now, the backdrop of a blue sweep with more incoming fiscal support as well as the current monetary policy environment is arguably right now the best shot that the Fed has and has had in more than almost a decade to actually reach that 2% inflation target of theirs. So the bank is expected to have the same old rhetoric from the last meeting, saying that they will pledge to continue that 120 billion in monthly QE until there's substantial further progress towards employment and inflation goals. However, with these recent noises about tapering running around, this meeting provides the Fed with a fantastic opportunity to put this topic to bed, so to speak, and for the next couple of months. And right now, the risk to not explicitly push back hard against taper suggestions in the upcoming meeting is just too big. big, and they've already thrown in everything alongside the kitchen sink. So why risk coming across tepid about this very important topic? So yes, vaccines are out and about and being administered at quite a fast pace, and that is all good, but it's still going to take some time for herd immunity to develop and for people to live, lives that resemble something close to normal, and that is obviously not good from a consumer spending point of view. And of course, in terms of recent data that we've had, yes, PMI data has been stellar, but in terms of retail sales, in terms of jobs, it's really been bad with the recent numbers, and doesn't change the fact that more than 9 million workers right now have either stopped working or can't find a job. So in a sense, the recent bad retail sales and jobs data that we had might act as a possible scapegoat for the Fed in this upcoming meeting, and gives them something to really hammer on about, definitively to anchor on as a viable reason for them to really push back hard against tapering, and saying something similar in terms of what they said about interest rates, that they're not even thinking about tapering asset purchases. So there's essentially two scenarios that we're looking at for a potential sentiment shift and a trade plan in the week ahead. Scenario one is where Fed Chair Powell delivers the dovish goods. In this scenario, we are looking for the Fed to really lay it on thick and explicitly push back hard against the notion that tapering is around the corner, and make sure to really anchor both that short as well as that medium term interest rate expectations, and rather choosing to come across overly dovish to just reassure markets that tapering is still a far way away. Now, in this scenario, we would expect to see upside for equities across the board. Our favorites for that would be S&P 500 and Nasdaq longs, and we would also expect that to see the dollar as well as US 10-year pushing lower, which could be a short-term saving grace for gold prices, which has been pressured over the last few days. Then in scenario number two, that is where Fed Powell takes away the cookie jar. In this scenario, we are looking for the Fed to come across very meek regarding the topic of tapering, especially during the Q&A section of the press conference. You see, if the market senses any type of meekness from them, or anything that seems like they are not really concerned about the recent taper talks as much as they should be, that could really see some very interesting moves in the markets. In that scenario, we would expect upside for the US 10-year as well as the US dollar, which is something that we would expect to pressure gold even further that we've seen over the last few sessions. Now for equities, the reaction might be a little bit more interesting, as sharply rising bond yields that's driven by expectations for less QE should theoretically mean that equities are less attractive, so to speak. But given the overall outlook for equities going into 2021, any downward move as a result of that might be more temporary and actually still be seen as a potential dip buying opportunity. That's it from my side for the week ahead video, guys. Any questions, as always, please don't hesitate to let me know.